years in London, co-managing the market making book for cross-currency swaps, FX forwards, and interest rate swaps in Scandinavia. So a very much directional macro trading culture. And I left in 2017 to join the crypto environment. And the way I expressed that move was by launching a fund. The idea at the time, and it's still the same idea, was obviously that was the time when Bitcoin hit its first awareness moment that something was brewing and happening when it reached 20K in December 2017. And so, a lot of people got excited, but obviously very poor infrastructure, very little vehicles and lack of trust in the actual custodians, and also how do you navigate such a market, with a totally different news flow, totally different metrics, and crazy volatility. Let's not be afraid of the word. So the idea basically is that this is still a fairly small asset class. I mean, it's a $2 trillion asset class if you count Bitcoin and if you remove Bitcoin, because more and more people are understanding that Bitcoin is a bit of a unique and different thing that what the rest of the asset class offers. But Bitcoin is 850 billion market cap, so it's still a good 45% of the market cap of the whole asset class. So the idea is a lot of people agree and feel, and there are a lot of signals showing that this is basically out of the box and more and more real in terms of what business can do with blockchain and the tokens, which are like commodities which allow you to use and run the blockchains, and so a lot of people agree that this is going to grow to probably a more sizable asset class, and we're probably thinking 10 to 20 trillion asset class, which obviously it would still be fairly small given that the market cap of gold above ground is 15 trillion alone, and the US equity markets, I mean, most developed countries equity markets all aggregated are above 100 trillion. So we're still at a very niche level, and 2 trillion market cap is basically smaller than one of the big FANG. I mean, you can remove Facebook from it now, but most of the others. So the question is, how do you stay exposed? I mean, you could basically buy and close your eyes. That's what a lot of people advise to do. But the problem with that is that can you actually suffer such volatility? Because the path toward the 10 trillion or 20 trillion size will be alternated between phases of 4 years and phases of panic and fear, and it's too much of a volatility to sustain. So obviously closing your eyes requires a lot of strength, and it's not really realistic. And the second thing is, if you look at the top 10 in the crypto market at the moment, you'll see that basically, except for Bitcoin and Ethereum, none of the coins which are in the top 10 were in the top 10 the last 2 years ago. And so there is, it's a fast-moving, very innovative, and so you need to keep an eye and obviously, adjust and portfolio with whatever are the new themes. Metaverse is a massively emerging theme, but 6 months ago nobody really looked at it. So we obviously focus on that. So which is why being investors in a fund with a team focused on it is obviously a requirement to be exposed to the asset class. So the way we proceed is we basically do, we could have 3 different funds because we do 3 different sort of activities, but they're all in one fund, and that's because it makes sense from a business strategy, but it also makes sense, because there's a lot of synergies between the different strategy. So the first element of the strategy is a selection of crypto assets. So we only invest in digital tokens. We're not talking about equities or shares of crypto companies. We're talking about the tokens, which I call digital commodities, because effectively a token is what allows you to use a specific blockchain. The Ether, which is the token of the Ethereum blockchain, is nothing else than a gas that you use to pay for transactions on the blockchain. So it's more a commodity than a currency. And Bitcoin obviously doesn't need a presentation anymore, but it's also compared to gold for very good reasons. And I don't think I'm going to talk about Bitcoin right now because I'm assuming most people have made their case on it, but we might on the Q&A do it. So we select. There's a lot of work behind. There's a lot of stuff you can invest in, and it takes quite a lot of time to review the whole ecosystem. And when you actually select a coin, you want it to be meaningful in your portfolio. So we have a rule that any position should be between at least minimum 2% of the portfolio. So we have between 15 and 20 positions in the portfolio, and we select this coin in a very old-fashioned bottom-up approach. So we add a coin whenever there is. So we have a set of criteria to select these coins, and these criteria are derived from the investment philosophy. So for me, what really makes this asset class interesting is the decentralization of the governance. That's really what makes the whole story relevant. You have basically a new form of business emerging, which are governed by users. And that's what Bitcoin is. It's a store of value and a payment system which is governed by the actual users, and no single point of failure, no institution, government can make a decision on it, and not even the founder of the coin. Or Ethereum is the same conception. You and I have as much decision power on the Bitcoin blockchain than the founder, which is still unknown, or of Vitalik Buterin in the case of Ethereum. The users and the stakeholders are the decision makers, and that creates a level of trust which is unseen in classic business. And that level of trust, and really we're moving from a world where we only had soft promises, because when you trust a government, it's only attached to the credibility of a government. But it's been seen that some governments can change the rules of the game. And actually it's being seen now. With any Russian offshore resident is being now losing control of his assets. And though I might understand very well why this is done, and the pressure point that works, you're basically telling people that what they hold, they don't really hold it, and that's really, I think, going down the line, like showing that dollar as a reserve assets, and even gold, because if you don't hold the gold physically, if you hold it through papers, you basically don't have access to it. So whereas in the case of Bitcoin, that cannot happen. You own cryptographically the coin. So this level of trust, basically, which is we're moving from soft promises, whether it's companies, institutions who own your data and control the transactions, have the decision power, to a system which is only based on credibility. That's the old world. And the new world we're talking about now is a world where, because of the decentralization of the network and the randomness of validators, you're creating a level of hard promise where, the code becomes the law, and the execution of this code is made on smart contracts. And that's creating a level of trust, which for any business which use intermediation is very valuable. So, just to give an example, if you're an insurance company, there's a use case to see that, a lot of people don't subscribe to insurance just because they don't necessarily believe that the insurance will play a fair game, or will, and so the trust, there's trust. If you're insured with Aviva, yes, you trust them, but to a certain extent. If now Aviva is saying we are surrendering, the decision power to a layer one blockchain like Ethereum, powered by smart contracts with full transparency, then you're moving from a soft promise to a hard promise, and that can attract business for them. That can create more subscriptions to their insurance product because there is that trust. And so though it might still think, we're starting to think, like there's a great example of flight insurance, where basically if your flight is delayed, there's a payment automatically triggered, and that's just looking at the time of takeoff, and that's, that type of trust is only doable through a blockchain, and I can decline that to anything where there is an intermediation, where there is the need for trust. Obviously, finance, which is based on intermediaries like providing trust all the time, is threatened by the blockchain activity, and that's why DeFi is obviously one of the hottest and most promising application of it. But it's true as well for the metaverse, where in the world, if you believe that there's going to be a metaverse, you then have to believe that there'll be ownership in the metaverse, and there'll be laws and rules. And obviously, because there'll be no physical entity being able to like act, you'll need to rely on an automated ruling system, which again is where blockchain. That's the value proposition of blockchain is, we can bring trust without any human intervention, because it's so a lot of things like this. But we select assets based on the level of decentralization of the governance. I mean, that's one of the criteria, but it's a fundamental one, because on the long term, that's really what we believe will stay and be used. So but we also look at things like network effects, because at the end of the day, if you're buying a crypto, you're buying a network, and it's Bitcoin is nothing else than a network. If Bitcoin was released 12 years ago, on GitHub as a code, and suddenly you had people joining the network and deciding I'm going to work on it, and each time you have somebody joining the network, it strengthens the network until you reach a point of inflection where it's the network, and it's very hard to. People say, oh, how do you know that there's not an emerging new Bitcoin which is going to come and threaten Bitcoin as it is? I mean, that probably won't happen. I mean, there are many reasons to say that, obviously, but the main one for me is that Bitcoin has reached, the brand and the actual usage and the distribution of nodes has reached a level of inflection where it's very hard. It's a bit like, WhatsApp. Tomorrow, if you're organizing an event, a birthday event, you're probably going to use WhatsApp, because at the end of the day, rather than Signal or Telegram or any other chat, because that everybody's on WhatsApp. So you won't have to add. That's the power of a network effects, and from that point of view, Bitcoin is far ahead. For the actual use case of store of value and peer-to-peer transfer of that store of value. And I don't like to say payment, because Bitcoin is not really useful for payment, but for transferring value. The network effects is there. So after looking at decentralization, we look at network effects, like behavior of nodes and acceleration of nodes and acceleration of the community, because that's obviously, you want to be buying stuff which is like below a certain crossing the inflection point in terms of network effects, because then, once you pass that point, you're the winner, and so, obviously, which is also why, I'm originally a macro trader. Like I have a very macro approach, but we're not VC, so we don't really, I mean, obviously we know teams, we look at them, but it's we don't buy stuff just based on the team, and we buy blockchain which are already existing. So our universe of investment is the top 200, and we're looking for the blockchain which are be the winner tomorrow, but they're already up and running, because we need to be able to observe the network effects. And the actual governance, and all the tokenomics attached to it. And obviously, we also try to be spread around the different use case, whether it's metaverse, decentralized finance, infrastructure, which are all the layer ones, stores of value, which we try to spread in all the different narratives of that market. So that end up with a portfolio, which is bottom-up selected, high conviction trades, long-term view. And that's great, but obviously there's somebody coming, so that's great, but the problem is you're still seeing a high level of correlation between all assets in this asset class, even though it has been improving. There are days where you can see Bitcoin down and Ethereum up, and Solana down. Like the market is a bit more mature in that sense, but you still having a very high level of correlation, which are usually above 50%, and so when we look at our portfolio, we have a matrix of variance covariance, and obviously the sizing of the position is going to be based on how uncorrelated they are to each other. So which is, it's like a VAR budgeting. So we obviously, because we have VAR limits, and obviously the sizing is also based on the VAR, but also in basic portfolio management, you want to add stuff to your portfolio which is not correlated to the rest of the portfolio, so you generate lower systematic risk and better alpha. So that's how we size the portfolio. I mean, obviously we also have risk limits constraint, but maybe there'll be question about this, but we have a framework of risk, obviously, which is well defined. So that portfolio is great, but it's still highly correlated. So in a depressive market, like we've been going through the last 2 or 3 months, obviously, no matter the quality of your selection, you're talking, everything is based on future projection, you're going to suffer, in terms of performance. And that's why we say we just don't want to be long only, even though we believe in these things very long term, we're going to try around that and using that portfolio as collateral to have a futures trading strategy. So using futures contract around it, so we can overlay the portfolio with delta management of the net exposure. And we have a range, so we want, obviously we want investors to know that they're always sort of long, so we have a long bias, and so we can bring down the net exposure of the portfolio to 20%, which means you will have an equivalent of 80% short on the future side. And we can also bring up the exposure to 120%, which basically means you have a 20% boost leverage, which is in cases where the market is in panic mode, or there's prices are fully too depressed. So that futures trading around it, I think, is useful because you could say, well, it's okay, I'll just whenever we feel the market, and obviously I'll explain what signals we use, and that's obviously a much more top-down approach of what's the net exposure we want in different environment. But we could just say we're going to reduce or coin core portfolio positions to cash, but that would not be optimal, obviously, because though most of the stuff is fairly liquid, you still will suffer a lot of slippage doing so, and logistically it would be difficult to keep the portfolio well balanced doing that in fast moving markets. So it's much more efficient to actually overlay that portfolio, and that allows you to keep your structural longs of single coins, while hedging, with futures. And the futures market is around, like most futures market, around 4 times the volume of the cash market for Bitcoin. And you have, obviously, as you probably know, 2 futures which are actually regulated and trading at the CME, which are Bitcoin futures and Ethereum futures. And then you have also most coins have futures on Binance, which are actually very liquid as well. It's like, I'll say the top 20 coins have very liquid futures. So you can easily find the right futures to proxy hedge. And that also brings an interesting dimension to the fund, which obviously then you become a basis trading vehicle where you obviously have long in coins and short in futures, which because you're a natural seller of future, because that's whenever you hedge the portfolio, you then benefit from the structural positive contango of this asset class, and obviously my background and the trader assisting me to do that was also from Morgan Stanley. We have good expertise in trading futures and expiries and managing the contango, and that creates a bit of more revenue. I mean, there are some months where we generated 2 or 3% of alpha performance just based on the cash and carry. So that overlay of trading is as I said, a macro, and this is becoming just a little parenthesis. I think at the moment a lot of people are saying and are disappointed with the fact that crypto is correlated to other markets, and it seems like it comes as a surprise to some people, and I think to me it was not a surprise. I think when you talk about correlation, you have to be careful what you talk about. Like there's what we call short-term correlation, and there's long-term correlation. So in the short term, crypto is correlated whenever the market is driven by fear. If and to that extent, Bitcoin is not really correlated to the Nasdaq, but it's correlated to the VIX. So if you have Nasdaq selling off fast and with a sense of acceleration to the downside, like we've been through the last 2 months, then you probably see Bitcoin doing it. But it's not. There's no causality. It's not because you see correlation that there is actual causality between these two assets. It's just that they're both being driven by an environment where there is fear. And it should not be a surprise to anybody that Bitcoin is a speculative asset with a lot of leverage and retail involved. And you obviously also have a liquidity element that if you're losing on your portfolio, you have to liquidate some positions, and so you liquidate whatever has been doing well. Or so whenever liquidity stresses and whenever there is fear, you should expect correlation, but that doesn't mean that it's fundamentally correlated. And that's actually, we saw that already. We saw that in March 2020 when you had the massive sell-off in equities, like whenever COVID became, like lockdown became a thing in March 2020, then Bitcoin gapped. And actually there were some special stories happening to Bitcoin. One platform, trading platform called BitMEX actually had a liquidation event. But my point is then when you recovered, like you have basically Nasdaq, which might have doubled, was Bitcoin did 10x, So then if you look at correlation, then it's no more correlated anymore. So my point is that in short-term frames, you can have correlation, but the idea is that on the long term, crypto is, following its own narrative as an emerging, innovative, new asset class. And so the correlation, and I'm pretty sure that within the next 3 or 4 months, people will again talk about how decorrelated it is, because whenever the fear goes away, and even if Nasdaq remains heavy because people are repricing valuations and thinking, well, and assuming Nasdaq might lose like 1% per month over the next 12 months, even in that scenario, that will not impact Bitcoin or crypto, because then it's no more about fear, it's about equities, and then there is no more causality affecting crypto, and then crypto can follow its own narrative, which is that at the moment it's the only exciting, innovative asset class, which is still at a very, very niche size, and where you can see every day VC funds like massively funding and developing the infrastructure and raising money to do so, and there might also be like a potential rotation in terms of narrative where 2.0 tech, as we've known it, has been sort of reach a maturation levels with the big FANG as we know them, and obviously been disappointing in terms of performance over the last few months, and so you could have a rotation from 2.0 to 3.0, and then crypto would be like the horse to ride in that rotation of narrative. I'm talking about a rotation at a deeper level, where like there's really a realization that the next big tech move is 3.0, which is there are many names for it, but decentralized web 3.0, whatever. But that's crypto basically. So the futures, we look at as anybody try to make have views on inflation, but that's macro. That's it's all even as an ex-macro trader, it would be lying to tell anybody that I have an edge in predicting inflation or predicting geopolitical risk. That's anybody's as we know guess. All we can do is basically and that's where we come in reducing volatilities, is we can basically identify whenever the market is too hot or whenever the market is too cold, and that's that's easier to do. That there are objective reasons to say the market is too hot, and so our natural trading strategy is basically that when the market heats up and does well, we reduce delta progressively, and when the market becomes very fearful and become cold, we increase delta, so that's basically applying the becoming greedy when the market is fearful and fearful, but that's sort of hard discipline where you basically feel lonely most of the time, but that's what on the long term smoothen returns and actually make you a winner in the long term, even though in the short term being 120% delta in the market like we had a month ago, which is very fearful, feels lonely, but that's over the long term. So we're basically applying just basic risk management, and the heating up of the market, is identified mostly through looking at derivatives. So we have a lot of metrics and signals. I mean, there are two big, domain. There is what we call market data, which is observing futures and extracting the level of heat that we can see in terms of structural leverage, and looking at open interest, moving averages on funding rates of perpetual futures, or whatever basis on term traded futures, and identifying because these things mean revert always, and so you can identify the risk for sharp liquidations, and that's usually when we reduce delta, whenever there's heating. And if somebody's interested about this, we can go deeper into how we observe the futures market. And then the second thing we look at is what we call in crypto, and that's very new. It's called on-chain metrics. I say it's new because it's basically a new set of metrics that we use and have, which don't exist in other asset classes, and which are existing only because the blockchain, if you look at Bitcoin, Bitcoin is nothing else than a big ledger of transactions, from now, which are constantly at the end, and you just see like the level of transaction and two addresses. So there are a lot of websites and companies like CryptoQuant or Glassnode who make it easy to read for users, and from that you can extract a lot of valuable information. And what's driving Bitcoin and obviously the rest of the market, because it's still like a thermometer of obviously the appetite for the asset class, is the feeling that there might one day not be no more supply for people to have some, and that's the underlying narrative. When you buy Bitcoin, you're buying actually, it's like a value trade. You're buying what you see as a cheap store of value, like macroeconomic store of value, because it's still priced as a niche store of value, but it could potentially, and I'm convinced it will, and be as important as gold, because what's going on is a generational shift where most of people at the moment, 88% of millennials prefer to buy a Bitcoin than gold. Millennials are people below 35, so it's representing a real part of the world, and 40% of Americans want to transact in Bitcoin. So I'm not saying like it's going to replace things, but I'm saying slowly it's going to be a natural allocation of savings and into that rather than into gold, for obvious reasons. It's programmable, it's digital, it's easy to store, easy to transfer, and so on. And so it will slowly capture market share versus gold, and we are playing that generational shift. That's why it's happening now, and not because we are in the time of digitalization, and if anything, finance and financial product is the only thing which hasn't really been digitalized. So that's where crypto is coming. But so on-chain metrics is you look at this ledger, and you can, for example, like very simple metrics but very useful. You can look at the proportion of Bitcoin which hasn't changed hands over the last year, and that's very helpful, because you can say, and actually that number is around 65%. So what is it telling you? That it's telling you that basically 65% of existing Bitcoin haven't changed hands over the last year, which means that the velocity of the assets is actually very low. And if you know equation of exchanges, like, which is mass time velocity equals price times quantity, the lower is the velocity, the higher needs to be the monetary mass for different asset. And velocity of Bitcoin is trending lower because most people actually, when they buy it, they don't sell it. Most people, and that's the structural trend going on. So obviously, we look at that because last May, for example, that velocity was picking up, and that was for us a strong on-chain signal that maybe some long-term holders were actually shifting, and maybe starting to think about taking profits. It actually happened, when in May we went from 65K to 27K in June. So everything which can give you a sense of what's the liquid supply on the market. So what are the Bitcoin balances on exchange? So we receive signals whenever there is a big deposit of Bitcoin on exchange, because obviously that means somebody might be selling spot, and that if you are in a market where the futures is trading at a high contango, which means there's a lot of leverage on the long side, then there's likely going to be a liquidation. So that's that's looking at these things we navigate. But there are a lot of other on-chain metrics you can look at. Obviously, you know, the velocity one is very important. The availability of Bitcoin at exchanges is another important one because it gives you a sense of liquid supply. But we also look at things like profit ratio, how much of the market is in profit, because it's very easy with Bitcoin to know, you know, when was the last time one Bitcoin traded, so you can aggregate the level of entry of participants, you know, and there are like quite good charts in terms of, you know, where, you know, the markets is at the moment in terms of profits, and usually there's a zone like around 9, like, you know, when more than 90% of people are in loss, usually, you know, it's usually bottom, and that's actually a zone we've been over the last 3 weeks. And same for the velocity element, you know, like you can also look at how many basically how has the long-term holders behaved, you know, and you can, because a bear market is like strats, you know, it's like you have the weak hands selling first, and then you have like a bit more convinced hand, and then you have like the die-hard believers which will never sell, you know. And what you want to look is where you are in that zone, you know, like, because and where we are now, and you know, I'll maybe share charts after the meeting if you're interested, but we're basically at a zone where for Bitcoin to sell more, you need some people who have never sold to sell, you know, so that will require, like, you know, a quite strong shipper mentality. So that's usually also a bottoming element. So again, on-chain metrics, a lot existing, a lot will come up, you know, it's like any market, you know, we're learning, but it's an exciting thing because you know, you would love probably to know that about some stocks, you know, how, you know, what's the proportion which hasn't moved hand, what is the level of entry, and that you can see because the blockchain is an open, transparent book.
Felix,
So
thank you very much. I mean, it's everything's been very useful, obviously, but we just want to be aware of the time and just see if anyone has any specific questions that they'd like to come up. So I'm just going to open up the floor, make sure everyone's still awake out there, and hopefully come in and no, it's not. Just want to make
maybe
sure.
Felix, maybe I'll start with a question so that people can slowly warm up. I think most of the folks that are listening in, you know, not everybody is yet fully convinced. I think something that Ryan and I have come up against is, you know, there's still quite a few skeptics out there. Might be a generational thing. Typically, sort of the older investors remain more skeptical. For some reason they believe in blockchain, but they're very skeptical on digital assets. I mean, what would be your answer to these skeptics? And this will be helpful also for those people that need to convince the people in their investment committee.
But skeptics about what? About the actual, you know,
yeah, let's say for investing in
about, because there are two types of skepticism. There's the investment opportunity, and to be honest, if you don't feel, see, or believe in it, you know, like there's no really, you know, there's no point having a talking about it, because that's, you know, it's something you send. And then there's a skepticals about how, you know, what funds are actually doing and the security around it and stuff like this. So you're talking about the actual investment case.
Yeah, the actual investment case. For some reason, it seems strange. This is something that Brian and I have bumped into. That you know, for some reason, some investors, as I mentioned, the older generation, they get the concept of the blockchain, but they remain very skeptical on digital assets and cryptocurrency. For probably still somewhat stigmatized by you know, the press from 2-3 years ago. But you know, they haven't really come along yet to understand that actually the two are very interlinked. But you know, from your perspective, what would you say to the skeptics or the people that are still a bit on the edge of let's say hesitance? You know, clearly, you know, this train has left the station, but what would you say?
Well, I mean, I'll tell you, I mean, I've talked about this, but you know, I'd say that, you know, this is a generational opportunity, and you know, this is a generational shift. You know, and it goes to like deeper things in society, you know, like where you can sense a desire for, like there's a defiance toward big institutions, toward the control of your data, of your money, of your, you know, and you can see how actually some big names like Facebook or Google struggle on that point. And so there is a general like desire in society to maybe move toward new forms of governance, you know, which are more decentralized, you know, users driven and everything. And it's not like a revolution we're talking about. We're not talking about a revolution. We're just talking about a shift And that sound investment on the long term is sensing this shift, in desire. And if you talk to like millennials, if you talk to, it's like people who are scared with metaverse, yes, even myself, I'm 35-year-old, like the idea of spending time in the metaverse doesn't really excite me, to be honest with you, because maybe I'm already maybe too old for that. But if I talk to an 18-year-old where basically half of his life is already, digitalized on TikTok and, where he's already buying like special unique filters, which will be NFTs in a metaverse world, to look different, and, where everything is already so virtual, like the step and the leap for him toward, a metaverse environment where he has his house there, and when he has, he can play video games within the real life and with friends, like all these things is not such a leap for him. So again, that's that's for metaverse. But generally speaking, for the blockchain opportunity, I think it's a desire to move away from a certain control of your data, your privacy, and the way things are executed, and corporates are resistant toward this, like anytime when they are threatened, until they see that that's the actual thing, and then they on board. And that's what we're seeing. We've seen banks fighting like in a bit of a blind, deaf way crypto, and now all you see any if you look at any capital raise in a crypto startup, you'll find like a few banks in it, and I'm talking about JP Morgan, Goldman, and everything. You're seeing it. You're seeing it in the regulation level. You're seeing it like they're offering trading and so on and so on and so on. Bonds are being issued on Ethereum via SocGen and BNP. So there's a lot of things going on. So that's the transition, but it's and then people on Bitcoin, people say it has no intrinsic value. I mean, I think again that's a leap you have to take in the virtual world. Like many things don't have intrinsic value. It has value because people agree that it has value. It's a social agreement. And there is actually a level of security on the network which gives that value. There's a cost of producing a Bitcoin, which is around 24K. So that's basically the marginal cost of producing a Bitcoin. It works like a commodity. And when it comes to other crypto, I mean, they have actually value. Like, if you own Ethereum, you can actually stake it to secure the network, because it's moving into a proof of stake network, and that generates like 4 or 5% yield. So here you go, Ethereum becomes suddenly a fixed income product, and that's actually one thing I'm talking about a lot now in pitches, because people don't really get that it's these things actually generate return, because like the blockchain will pay you part of the transaction fees to thank you for staking your coins to strengthen the proof of stake security consensus system. So you are and actually I haven't mentioned, but the third dimension of what we do is that is we use our inventory to access DeFi, which are smart contract, which is basically like financial operations on the blockchain, but also staking and lending, and we monetize that balance sheet obviously much more actively now, because we can do it through our custodian, where before we could not. So we can do it through our walled garden of custody, which is Copper. But yeah, I think that's what I would say. I would say, sense the generational shift. Don't be afraid of like the new underlying products. Even though it might sound virtual to you, for many people, virtual is not a problem. And actually look at the reality. There is an ecosystem. There are tokenomics. There's reward for holding tokens, and like any financial asset.
We've got one hand up from Jan. You can go ahead, Jan.
Hi, Felix. Yeah, thank you. Thanks for the introduction. Felix, what I still don't totally understand is really, what's your value proposition? What is your target? What are you looking for? What do you want to achieve in your fund? And why should I invest with you and not directly in Ethereum or Bitcoin?
Okay, so I mean, at the moment we're $120 million AUM fund, which puts us in the league of like UK managed funds, especially the one doing only crypto, because there are a lot of funds who do VC and hybrid. So obviously the target here is to become a much more important size fund, with different products eventually. We have for almost like 3.5 years of track record, which is not that common in the asset class. A lot of funds like launched recently. So what am I trying to achieve? I'm trying to say that basically, this is just more than like a trade. Bitcoin, it's a new asset class. So like any new asset class, you're going to have different things to do. You know, like you have, you know, long-only funds. You have arbitrage funds, you know, which exploit like different, you know, so like, because we also do short, you know, like we do long short, so we short single stocks. It's limited to 20% of the fund, but you know, we do it up to 20% of the AUM. And obviously that's like to fight, you know, and to monetize the fact that a lot of stuff is driven by hype and, you know, it's completely overvalued. And I'm thinking like Cardano blockchain, sorry, I'm thinking Binance blockchain, I'm thinking Luna blockchain, you know, stuff like this. So, you know, what am I trying to achieve? I'm trying to like be positioned as an asset manager in an asset class, which like, you know, which looked like 2 years ago, just one trade belong, and now it's moving into, you know, you have like, you know, funds like just doing, you know, mining and capturing the mining business. You have funds just doing pure RV trades, and you know, you have, you know, so it's burgeoning into like an asset class with different type of activities and fund. And then within the asset class, you're going to have like funds specialized in metaverse, NFT tokens, funds specialized in decentralized finance token, just like you have, you know, funds specialized in pharmaceuticals, tech, or utilities in equity, you know, that. So, you know, what I'm trying to achieve is just, you know, be grow and be present in that asset class, which for me there's no doubt that it's basically, you know, becoming like an equivalent asset class to equities, you know, on the long term. The second question was why you should be in the fund. I mean, you should be. My honest answer is going to be like, we have a much better Sharpe ratio than Bitcoin alone. So, you know, if you're asking me why should I invest in your fund rather than Bitcoin, I say, well, you know, because you're basically investing in a better Sharpe ratio, and I'm talking about the Sharpe ratio net of fees. We are less volatile than Bitcoin. We have a 17% standard deviation, whereas Bitcoin has a 25% standard deviation. We obviously, as I said at the beginning, it's a fast-moving asset class. So, you know, the top 10 of the top biggest cryptocurrencies today, only Bitcoin and Ethereum are, you know, the same, you know, like over the last 2 years, basically, like in the top 10, like the 8 which were in the last 2 years ago are not in anymore. You know, I'm talking like Ripple, EOS, all this, you know, sort of crap, hyped decentralized blockchains, not decentralized blockchain. So, you know, you have, you know, why often you're going to say, well, most funds are going to be the same. They're going to be active selecting. I mean, I think, you know, what we bring different to the table is, you know, I've been working in Morgan Stanley as a prop trader in London for 8 years. I think you don't find many funds in crypto run by actual sophisticated professional traders who have seen other markets, you know, and understand finance as it is, you know, how you talk to a broker, how you manage volatility, how you deal with, you know, a lot of crypto funds are run by what I call crypto junkies, which are people who bought Bitcoin in 2014 or 15, and they think they're trader because they've been riding, you know, a wave. But trading is not about that. Trading is about, you know, the discipline, about risk management. We have a, you know, our risk manager here comes from a Man Group, which, as you know, is the biggest hedge fund in the world. He was running the risk for the multi-strat fund, and you know that these are things, these are valuable skills in a market which is a bit of a, you know, immature cowboy, you know, new market where, you know, you can you know, just the fact we're looking at a matrix of variance covariance to construct the portfolio. I don't think many funds are doing that. The hedging, you know, and, you know, extracting information from brokers, from whatever, you know, intervenant. You know, these are skills you learn as a trader, you know, not because you've been long Bitcoin since 2015 and, you know, you just, you know, feel you know everything, and you might know everything about, you know, this asset class, but managing it's one thing. So I think that's what, you know, the team is basically, you know, and that's all the hires we do are based on that criteria, that we need people who've been in traditional finance at a sophisticated level, and at the same time have faith, obviously, you know, and connection in this asset class. I mean, I have mindset because I've been basically in this market at a professional level for almost four or 5 years now. So, but you know, you don't. Obviously you need somebody who's in that ecosystem as well. So that's, you know, like the risk manager I had, you know, he was at Man, but in between it was at a crypto fund, you know, so he has both of the world. So I think that makes a difference. But then also like just the numbers, you know, like we're just able to like, and I think you also don't find that many funds which are like, you know, doing most of the things, you know, in the SK, which is like long, short trading, and also accessing DeFi, so monetizing balance sheet staking and everything. Like we have a sort of a broad access to the different things you can do in the market.
Maybe I'll step in and ask a question that might be interesting for everyone to hear. Perhaps you could speak about, a position that added a lot of performance to the portfolio, and how you picked it, how you managed it, how you exited it, and perhaps also you could speak about a position that was not a good position that maybe you had to manage on the downside, and how you managed that. Might be helpful for people to hear that.
So, I mean, yeah, without getting into too many details, like, in February of last year, so 2021, we saw that basically, at the time there was already a very interesting narrative in the market, which was layer ones, like, which are basically Ethereum, Solana, Cardano, all these blockchain, which are basically on which other applications are building, and and renting the decentralized power of this blockchain. So it's like the layer one, like like HTTP is for internet, and so at the time it was basically Ethereum, only about Ethereum. But Ethereum, is extremely, and that's really their honor to be, but they're extremely focused on decentralization, and the community, and so obviously when you focus on centralization, you have to compromise on things like scalability, and Ethereum has suffered of like congestion on the network, which translate into very high fees and everything. And so we at the time, made a rotation into, blockchain, where actually, that was tactical, because obviously, we believe more in Ethereum for the decentralization. But at the time, there was a boom in decentralized finance, and we were observing that many apps were jumping out of Ethereum to build and run on stuff which is less decentralized, but still technically advanced, like Solana, and at the time was Binance, also Binance Smart Chain. And so, despite the fact that Binance Smart Chain long term, is actually a short in the fund now for the hype and the centralization. But at the time, it was clear that it was actually cheaply priced and will benefit from that activity. So, we've rotated from Ethereum into those chains, and obviously they actually, like, that narrative, activated, and there was crazy performance on these blockchains. So that's an example, like a trade we haven't done well, actually. Well, actually, I could say the same thing. We have been short of Binance token for a while now, and it has, it's actually slightly in the money, but it has costed us, because we're doing it through futures, and the futures funding rate is negative, and that's because so net, I think it's still a losing trade, and the problem with that is that Binance, has, a lot of DeFi systems which, they have a monopoly, basically, where they host a lot of launch of DeFi systems which are coming in to do some yield farming, and so there's always a demand for the Binance token, which obviously is not helping the short because of that, despite the fact that the actual quality and so we've been holding that trade for too long, and it hasn't been massive downside, but it had cost us in carry, because obviously a lot of people borrow the token to be able to access these launch pads, and they hedge by shorting the future. So the future trades in backwardation, which means you actually, like, always, if you long the future, you're paying a rate, you're paying a fixed income. So that has, that's because we underestimated that launch pad activity and everything. There's been, yeah, and I can talk about one trade we really love at the moment, which is Yearn Finance. Like, it's 5% of the portfolio, but in VAR allocation, it's closer to 6 or 7%, because it's, which means it's a decent position for us, and we see it as a value trade. Yearn Finance is like an algorithmic hedge fund, on DeFi, which is basically like, algorithmically allocating money put in their vaults to different DeFi protocols, and it just take commissions. And it's been around for like many years, and it's fully decentralized. All the tokens are out and belong to the community, so there is no developer who owns more token than another. And it has accumulated 250 million in its treasury of reserve from the running the business, which can be from time to time the community votes to, like, so you're basically talking about a normal company running on the blockchain but controlled by users. So the community vote for the treasury to buy back tokens sometimes, and that's what sustain the price, and how they pay themselves effectively. It's like a share buyback, and And so the last 12 months revenue was around 200 million as well, so basically and the market cap of the token is 800 million. So it's basically like in terms of PE ratio equivalence, like something around 4 or 5, which for today's standard in the normal tech is very, very low, and for crypto is even lower. So we like that because it's a healthy, with the value locked in the protocol has been growing healthily. The stream of revenue is actually quite solid. There is a reserve treasury of 200 million, so basically price to book is only 4x the actual value in the treasury. So it's actually quite cheap and exciting, to own this token, because you have recurrent share buybacks which sustain the price. So I think long term that can do very well, especially when institutional money increase their allocation. They will be looking for stuff like this, with a real business stream of cash flow, and so they'll be like chasing this type of coins, which are actually easier to understand for them, than a metaverse coin or something like this.
Thank you, Felix. Does anyone else have any questions? If not, I can ask another question. But feel free to come in, please, if you're there. But I was wondering, you mentioned
Ryan.
Yeah, sorry, go ahead, Constance. Yeah, go ahead. Thanks.
Yeah, Ryan, just one question. Thank you very much, Felix, for the presentation. How do you select the cryptos? Because you said that, for example, 2 years ago, you had not the same cryptos as you have now in the portfolio. So what are the main criteria? Is it like, I don't know, the volume, the liquidity, the project behind the crypto? What's your criteria?
Sure. Thank you for the question. I mean, our criteria are, so by the way, when I said, I mean, yes, we rotate the portfolio. I mean, the portfolio is fairly sticky though, but yeah, over the last 2 years, obviously we rotated a lot. Like we might have 1 or 2 new positions in the portfolio every trimester. But what I was referring to is that I was saying, when you look at the top 10 of crypto, that none of the coins which were there 2 years ago are there anymore, except for Bitcoin and Ethereum. But yeah, so the selection, I mean, I've talked a bit about it. I could go in more detail, but the selection is, obviously it's bottom up. So first we look at areas where we want to be invested, where narratives that we believe in the market. For example, like anything at the moment which is what we call RDeFi, so regulated DeFi, which are like basically decentralized finance protocols which are compliant with the standards of finance. I actually think, I believe, are going to be very exciting, because they're easier way to plug in. Whereas like the sort of like far west, crazy anarchist DeFi, obviously it's going to struggle to become like real and scale in an environment where the regulator is looking at it. So the use case, so once you're in that RDeFi space, because you believe in that space and you want to be exposed, then as I said, the first criteria for us is which coins have actual decentralized governance, because a lot of crypto stuff, says it's decentralized just in name, but the reality is that you have very few validators. So effectively, you could have a collusion of validators to validate transactions. So, like the best example of decentralization, which is Bitcoin. You don't even know who the founder is. It's like millions of nodes around the world, and but you're looking for decentralization, and I say that's because I believe that's the real value proposition of this asset class, and it's also what makes you trust that the token might hold value. Because if you have a token where suddenly the rule of the game can be changed by 1 guy or 2 guys, then obviously it cannot be a store of value. So decentralized governance, and for that we observe like the distribution of token holders and nodes, and the activity, and like just what we call tokenomics, and how is it decentralized or not. Then I said network effects. So again, that's observing like community, and because we want to buy networks, we want to buy things where there's a community which is going to grow the network. So network effects, and where we are in the classic shape of a growth of a network, where are we on this elliptic shape. Then I'd say in terms of valuation, always very hard to value things. I mean, I gave an example like Young Finance, where we can actually value, and that's something we like for that reason actually. because there's a stream of revenue, but there's a lot of stuff you can't value in crypto, just because, you know, the level of vertical integration, and, you know, it's future tech, you know, like for many, in many cases. So how can you actually, you know, value it? And to be honest, there's no real answer. But what you can do is relative value. You know, you can say, okay, these two blockchains are competing on the same, you know, they're two layer ones. You know, how much value is locked in the smart contracts? What's the actual size of the network? What, you know, and you can say, okay, well, this wise actually, you know, what's the transaction output? You know, how much transaction are executed on that network every day? You know, if you exclude the one which are like just washing of trades, which many blockchains actually have, you know, and you pretend they have a lot of transaction, whereas it's just wash transactions. And you look at ratios like, you know, NVT, network value divided by transactions, you know, to see actually Bitcoin NVT is very low at the moment, which also is a sign of cheapness. And so then relatively you can say, well, this is the cheapest way to play, you know, within, like, you know, healthy networks, decentralized in that narrative. So that, you know, that's the thing we look at basically.
Thanks, Steve. And it looks like Andrea has a question. Andrea, are you there?
Yes. Hello, Felix. Thanks for your presentation. I just have a couple questions. I was wondering if you engage directly in any DeFi strategies, like on Yearn, for example. And the second question was, do you still see the cash carry trade delivering the same types of returns you mentioned going forward? Yeah, thanks.
So obviously, yeah, we do as a fund actually engage in DeFi. So basically we haven't done it. We're only doing it since this year, January this year. And the reason for that is to go, like, you know, we are a fund, so we have a security and we have a custodian, you know, and in the past our custodian was called Coinbase Custody, which is basically simple cold storage, you know, with multi-signature and security level to get out. But then we moved to Copper, which I'm sure you've heard of, which is like, you know, the most exciting and biggest at the moment custodian for crypto funds, where they have a technology of walled garden. And, you know, I'm not going to develop the technology, but basically they allow you to keep moving your coins while being in custody, because there's a system of like whitelisting and sharding of the whitelisting. And so basically now we can move our coins within the portfolio while, you know, having them secure. And so we can now use the coins we have, you know, whether it's Bitcoin or Ethereum or other crypto, to go in and that they have a thing called Copper Connect, which is like MetaMask, but with Copper, with a custodian, which is safe, where you can access DeFi. So we only do smart contracts which are very established, you know. So we look at, you know, positive ratings and smart contracts which are at least 1 or 2 year, you know, and bigger value locked in. So, for example, we have a big inventory at the moment. We're overweight in Ethereum, you know, versus the actual market cap of it, and we're using that inventory to access DeFi. And we are in 2 protocols, which are Lido, which is basically a protocol which allows you to convert your Ethereum token into SETH, which is a staked ETH, so which has an embedded yield of the staking, and still use that to provide liquidity on that same smart contract. So we also in Curve, where we basically do some yield farming while providing liquidity to the protocol, and that's the 2. And we also in Merit Circle. Merit Circle is a gaming coin we have, and that's also a staked as a security in the protocol. So at the moment we have around 13 or 14% of the portfolio which is actually in DeFi within custody, you know. But we cannot do like crazy DeFi or, you know, like the stuff which is, you know, because we need only smart contracts which have at least 1 or 2 years of existence and have a very high TVL. So we do, you know, what you would call boring DeFi, but you still get like 4 or 5% yields on whatever you allocate to it, which, you know, is valuable for a fund to do, you know, if you have inventory rather than just keeping in cold storage. For the cash and carry trade, I mean, yes, I think I mean, it's like everything, you know. And crypto is a bit like hedge funds in the 90s, you know. Like, you know, you still have a lot of like asymmetry of information. You still have a very difficult market access for many players, you know. And so from that derivates opportunities, mispricings and imbalances or inefficiencies which are not corrected. But it will, you know, over the years become less and less of a trade. Of course, you know, that there's no chance it stays that high. But I think that process is a slow process, you know. So you still have, you know, I think quite a few good years of, you know, nice cash and carry. But I don't think, you know, I mean, you see it actually, like if you look at the 3 months rolling basis on futures, you know, it's been obviously it's correlated to the heat in the market, you know, because whenever there's heat and FOMO, that's where there's a lot of leverage on the futures, and that's where the cash and carry becomes great, which is great for us because it's usually when we actually start to hedge by selling futures, so we actually become short of that basis. But you can see that the rolling basis have been in the last hit and peak of the market, it hasn't reached the level we knew in the past. And actually, that's why many traders like ourselves have been, you know, I've made the mistake of thinking that the last peak was not the you know, that the market will actually go further, because it didn't look as hot based on the basis and the funding rates than it was in the past. You know, so that look, you know, but clearly, like, I know myself, I talk to a lot of like big, you know, multi-billion relative value funds in London. Some of them which are invested with us, some of them we work with, and which are all launching crypto relative value trades, and that's what they're doing. They're basically long coins, farming them in DeFi and shorting futures against it. So, which is why, by the way, the open interest at the moment in futures, despite the fact the market is fairly depressed, is still very high. And people are like, why? It doesn't make sense. You should have had liquidation. Well, this is because most of the a bigger part of the open interest in futures is actually hedged by coins, or because it's basically just arbitrage of that trade. So I think it's still fairly juicy. I think, you know, like, I mean, annualized contango in very hot markets used to go to 80, 100%, which, you know, it's crazy. Now I think you're targeting more like 30, 40%, but that's still like, you know, it's still juicy, but it will come down over the next 5-6 years for sure, with the infrastructure, with the regulation, like allowing more and more players to do that trade. That's inevitable.
Thank you very much, Felix. We've gone over the hour allotted to the call, and I'm very happy to continue if there's any more questions. But if there are no more questions, I think we'll end the call now. So I'll give everyone a last chance to raise their hand. Otherwise, just want to say thank you very much to Felix for your time today. I hope it was helpful to everyone on the call. And if you have any further questions or would like to see further material, you can obviously get in touch with us. You know where to find us. And otherwise, wishing everyone a nice weekend. And thanks for everyone for attending.
Thank you, Felix.
Thank you very much.
Felix.
Thank you very much.
Thank you.
Bye.
Thank you,
Bye.
everybody.
I mean, yeah, you can, well,
Thank you, Felix.
the people can like reach me directly if they want to, like, you know, you can let them know. I'm very happy to answer questions directly. All right.
Okay, thanks, Felix. Thanks so much.
Thanks, Ryan. Speak soon.
Thanks a lot. Take care.
Bye.
Thanks. Bye.